Hi guys, it's your favourite YouTuber again, Dammy Silver, and you're watching, you guessed it, DS Learning Finance. Whoa. Now today's episode is about how to select the right stock. There are two main aspects as to how to go about doing that. And if I grab your attention enough, keep watching, you know, it's coming. Now you want to invest in a stock which you have a genuine interest for. Why? Because you're more likely to want to dive in deeper, you're more likely to really want to understand the core foundation upon which that company is built on. I always say when it comes to investing, especially starting out, you want to invest in a company that you've been using their products, you've been using their services for a very long time, and you're generally happy with their products and their services. For example, if you're really into a specific chocolate brand and you've loved that chocolate bar for ages, why not see if that chocolate bar is available to invest in? Because if you're yourself are obviously interested in that product, you've been buying that product for God knows how many years, then there's bound to be other people that are dependent on that product as well, and therefore there can be an opportunity from it as well. So it's always good to start off with a company that you have a genuine interest for. Now, for beginner investor like myself, one half of the aspect that you have to focus on is the financial. Now, don't get carried away with the financial because it's yin and yang conflict. You need your financial, but you also need just as much business strategy to balance out the two and make sure, therefore, you have a good stock to invest in. So with that said, there's some sort of screening process I do. I like to sift between all the companies in the highest quadrant of that particular country. For example, I'm in England, I'm in the UK, so obviously I'm a beginner, so I want to put my best foot forward in terms of I don't want to be taking risks. I want to be taking investments with more reliable companies, so blue chip companies. I will invest in a stock that is in the FTSE 100 because I'm a beginner, as opposed to investing in a stock that's in the FTSE 250 or the AIM market. If you're in America, I would definitely recommend investing in the Dow Jones because that's obviously the top companies are there, and you're more likely to have a sort of steady increase with your money as opposed to the drastically fluctuating other markets, which aren't as profitable, which aren't as big as the blue chip companies are. With that said, there is a screening process. What I like to do is focus on some points for you guys to obviously sort of get through, sift between all the companies that are potentials and companies that are complete waste of time. What I like to do is I like to aim for companies that have a P ratio of 15 to 20. Obviously you guys know what P ratio is about. For those of you that don't, just watch my previous videos, it's all there. A quick summary, P ratio obviously tells you the price per share divided by the earnings per share. So the lower the P ratio, the better, but don't let obviously a low P ratio fool you into obviously investing in a company, because looks can be deceiving. With that said, you want obviously as low of a P ratio as possible within reason. So that's why I put that 15 to 20 range. That's a sort of good P ratio to start with, because it means that the stock's profitable. When you're investing in it, it means that it's a profitable stock. That's my first point. My second point that I look at as well is the dividend yield. I stress on about dividend yield so many times, guys. Dividend yield is the most important thing when it comes to dividend stock investor. You want to aim for a dividend yield of 2 to 5%. Just like anything good that tastes good in life, like sweets, when you have too much of it, it can be detrimental in the long run. I.e., when you have too much of the dividend yield, looks can be deceiving. It can be too good to be true. And companies that tend to have a higher yield than like 10%, for example, those companies tend to really reduce down on the dividend yield later on in the process. They can't sustain it because it's simply too much. So with that said, I tend to aim with a dividend yield of 2 to 5%. Or also you need to look at the dividend cover. That's almost just as important as the dividend yield. Reason being is because it tells you how how much money the company has to cover your dividend. So if they paid you in 2017, by the end of 2017, the dividend cover would, if you had a dividend cover of 2, that would mean that they could pay you twice as much dividend if they really wanted to. So the dividend cover is kind of like a backup, just to say, okay, this company is able to pay me a dividend yield steadily and increase as time goes by, which is sort of guaranteed, which is a cushion, it's a safety margin. Now, another important aspect is your revenue and profit, operating profit. This is so important. You need to make sure that the stock you're investing in, as a beginner, your revenue and your profit, your operating profit, are steadily increasing. You do not want to invest in a company that has a low revenue 1 year and then has high revenue another, and then it has consistently alternating. Likewise, you don't want to invest in a company that has the same sort of scenario with the profit. You want to invest in a company that has a steady increase with the profit and a steady increase with the revenue. If the ratio of the profit to the revenue is increasing, that's even better. But all in all, you want the general trend to go up, because that means that the company is constantly bringing in money, they're constantly growing. You do not want to invest in a company that's stale. You don't want to invest in a company that's not growing, because imagine inflation increases as time goes by, and if the revenue of the company is not increasing, then really you're actually losing money when you think about it. Okay, so you've managed to now screen through the FTSE 100, the Dow Jones, and you found that one company that, or maybe even you found 10 companies that you potentially want to invest in. Now's the time to dive in deep. The screening process is just to filter out, just to obviously utilize your time. There's no point reading through 100 companies in the FTSE 100 if only 5 of them apply to your scenario financially, if only 5 of them fit your criteria financially. So the screening process is just a quick sort of way to filter between the duds and the buds. Now it's time to dive in deep, understand the business strategy. Now the business strategy is crucial when it comes to investing. A lot of investors miss reading about the company. They miss, or they just don't do it in full depth. It is important to read about the company. I cannot stress it enough. It's so important. I recommend going on investor websites. So if you're investing in Apple stocks, if you find out the little, investors tab in the Apple website, that's where all the information is for investors. So what you want to do is go there and then obviously read more about the company. Now you have these reports, these annual reports and semi-annual reports and quarterly reports as well. So the annual reports are called 10Ks, the quarterly reports are called the 10Qs. Now the 10K tells you an overview of what the company's been like for the past year. So it's always talking in respective of the past. Occasionally they do speculate in terms of the future, but what is set in stone, what you can trust, is the past, because obviously it's happened. So you've got to read through these 10K books, these 10K documents, and they're quite hefty, so you've got to put on your reading glasses, guys. You've really got to be dedicated. Once you've gone through that and you found out, okay, the company's got similar sort of aspirations as you, that they align well with your sort of ethics, your morality, the way that you view life. Maybe they're doing things that you may want to do in the future. That's a good sign that it's a good company to invest in, because you want to invest in yourself ultimately. Therefore, you want to make sure that a company you're investing in has the right aspirations and aligns well with what you're looking to do. So let me give you an example. You wouldn't invest in a tobacco company if you were completely a healthy person, if you were vegan, for example, and you wanted to treat yourself, and you always obviously fed yourself healthy food, you always exercise, you wouldn't really want to invest in a tobacco company because it's a conflict of interest. So that's just one example of why you want to obviously make sure that the business has the same ethics and morality as yourself. So that's the 10K. Now you've got to also read through the 10Q, which is sort of the last 3 months of success that the company's had, hopefully. You want to read through that just as much as you want to read through the 10K. The reason is because in the 10K, it gives you a general overview of the year, whereas in the 10Q, it kind of specialises just in that specific 3 months. And it's more up to date, it's more recent. So yeah, that's obviously what you've got to do. After doing that, you need to now watch some conference videos. The reason being is when you read these documents, these 10Ks, these 10Qs, you're reading it, so you're not really seeing the genuine aspect of it. So as opposed to if you were to watch like a conference video about the company, you can generally see when someone's trying to lie to you, basically, because you can see them visually, you can visualize how they are, you can predict body language, gestures, the way he speaks, the way she speaks. That can completely give you a good initiative in terms of sensing whether that person's being genuine or not. So you want to also look at the conference videos. Also, conference videos can show you their personalities in terms of the execs. Do they look motivated? Are they really just doing it just for the money? So there are those things to think about. After that, you then want to read news, articles, all sorts of the latest news on the company. What are they doing? What are they looking to do in the future? Are they helping people? Has there been any injuries in that company? How high are the injury rates? All sorts of news, every and all sorts of news. That's what you want to really dive into, because that obviously gives you even more recent update on what the company's doing, how the people view the company. And if they view the company in a positive light, then that's really good, because it means that they're going to always be trusting that company. They're always going to be buying their products and services, which ultimately means more money for you. Now you need to go back to the financial and find out more detail in terms of income statements, in terms of cash flow, in terms of balance sheets. You need to look at all of that information and obviously make sure that the figures make sense in terms of the figures are progressing forward, basically. This is why I said previously you need to look at the company and make sure that the revenue and the profit is increasing. Because if you weren't to do that initially, you could have gone through all that reading and found out that the company is not actually very profitable right now. So it's good to do that screening process, to sift between the buds and the duds, and then obviously dive into the business, find out what it's all about, and then once you've got that, go back to the finance and dive into the finance again. So you've got the foundation laid, and now you're just building upon it. So once you look at the balance sheets and the cash flow statements and the income statements, it's obviously got your tick of approval, your signature of approval, and ready to invest. However, it's really crucial to know that it may take 50 goes, it may take 100 goes to find just one company that's worthwhile investing in. But that's why this method is so tedious. All in all, if you like this episode or you like my previous episodes, because I know there's one you're gonna like, yeah. Let's be real, there's gonna be one you're gonna really like, love even more than like. But yeah, if you like this episode, obviously you know what to do. Like, you like my face, then you know what to do. Subscribe to my channel, because there's more of this beautiful face to come. And then also, if you obviously want to get this group chat going, speak to other people, see what their thoughts are, and see what my thoughts are, and get in contact with me, then share this video, guys. Let's do this. LSS, yes, learning families. Boom.